Good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to our live stream. We sincerely hope that all of you are staying safe and healthy at this time. Today is going to be an awesome lineup. We are going to start with the topic of credits and incentives, so how to bring dollars to your organization with hiring a remote workforce. And I have Patrick Hanlon with me to explore that topic. So welcome, Patrick.
Hello.
We also have another topic that I know is near and dear to many organizations, and that is supply chain issues. So we have Tim Irvin from our manufacturing and distribution team, and he is going to bring timely insights and strategies on how to cope. So welcome, Tim.
Thank you. Hey, Leslie. Great to be here.
Now, before we dive in today, we have some housekeeping that we want to cover. So first of all, we have the ability for live Q&A during our session today. In order to participate, you have to register and log in using the link below me. And you are going to have the ability to like questions and move those up in priority so that we can better address those. We have moderators that are standing by and they are ready to engage and interact with you. We also want to let you know of a couple special events that we have upcoming. First of all, we have not one, but two financial health campaign series coming up. The first one is coming up very soon, and that is on alternatives in today's market. That is going to be on September 21st, and it's going to be followed up in November on year-end tax planning. So watch out for those. Those are great series, and we know we have a lot of people that have all of these policy changes on their mind, and we're going to be talking about those a lot in upcoming live streams as well. Second, you may not know it, but October is actually cybersecurity month. So we're going to have two webinars on that during October. One is going to be on cybersecurity preparedness, and the other one is going to be on cybersecurity as it relates to your employee benefit plans. So be sure to check all of those out. You can register for those on our website. And then finally, be on the lookout for webinars, articles, thought leadership, and always contact your CLA relationship because we absolutely want to engage and interact with you. So with that, let's start with Patrick. Patrick, we are going to explore credits and incentives today. It's always a great idea to have these conversations anytime that you're adding people, adding capital, or doing training. So those are the things that I like to hear for when we're thinking about that. But the world is really changing. So we've got a lot of people now that are going to remote, and that's becoming more of the norm. And I think states are starting to revise their credit and incentive programs really to accommodate this changing norm. And in fact, you have a new article that you just wrote about this. So I thought what would be great is let's talk about the highlights and what people need to know about this, especially in light of this article you just published.
Absolutely. Yeah. As most everyone knows, the typical triggers for credits and incentives activity are, hiring employees, creating jobs, making capital investments, and then also doing training of your workforce. And a lot of those are tied to, having a physical location. Those employees used to have to show up to a facility, a plant, or an office location in order to qualify for those incentives. States are recognizing now that, there's a trending shift in remote employees and telecommuting, and they're starting to react by adjusting their incentives programs towards that trend. It's a little bit of a mixed bag, but there's quite a few states that are reacting to that. And then we have some states that typically already included those employees in their included remote employees in their eligibility categories. For example, Missouri Works is a job creation program in Missouri, and the benefit is tied to net new job creation. Those employees have to be tied to a facility in Missouri, but if employees aren't there at least 50% of the time, if they receive their direction and control, they are still counted towards Missouri Works. And that was established in 2012, typically for your truck drivers, salespeople that were out of the office and things like that. But now we're seeing a shift in more states specifically addressing remote and telecommuting employees for their incentive programs.
Yeah, so this is really exciting news. And so as we think about considerations as states roll out these programs, what do you think organizations ought to keep in mind as they think about this?
So you still have to meet all the typical requirements for receiving a tax credit or incentive award. That is, you have to make maybe a certain level of capital investment, or offer a certain amount of health care that the company pays for versus the employee paying for, and meet average wage thresholds for the area that the facility is located in. So all of those still stand, but now you have some new requirements. So if you're going to have a remote employee tied to a physical location, they also have to meet possibly some special wage requirements tied to their residence. But they also have to be careful, or employers have to be careful, because there are, tax credits and incentives are great, but they can also trigger additional cross-border state and local tax issues that, having a remote workforce, we're kind of still digging into.
Yeah, I think that is a really good point. So there's like the carrot and the stick, almost, if you will, with the incentives being the carrot, and then the state tax issues. And that could be unemployment taxes, or it could be state nexus issues for the organization being the stick by these remote employees. And so I know we have a great article that's on our website for anybody who can't sleep tonight on these state tax issues as well. And so, Patrick, maybe what you could also do is highlight a few of the key states that are creating these incentives that are accommodating remote work employees, because I know there's a few states that are really just popping out as lucrative as we think about this.
Three of the big ones that I highlighted in the article are Kansas, Ohio, and Georgia. Ohio has something called the Job Creation Tax Credit. It's a refundable tax credit, which basically means it's cash if you don't have the burden. Otherwise, you take it against your commercial activity tax. It's based upon new job creation, but really the new payroll that you create above and beyond your base payroll level. You can now include remote employees in that payroll calculation, where you couldn't have before. So beginning after calendar year 2020, the job creation tax credit in Ohio, you're allowed to use your remote and telecommuting workforce going forward. There's really no end to that at this point, unless they statutorily go back and change it. So this is great. The requirements are that they still meet, certain wage thresholds. They have to be a resident of the state of Ohio. And interestingly, the majority of the work they do has to be done at home. So they can't be a remote employee, but really working in Kentucky or someplace else. They want to monitor and make sure those employees are doing the work from home in Ohio. In Kansas, they actually came through and procedurally changed that all the remote employees and telecommuters can count for all of their programs, which is really great, because they have some great programs in Kansas. The PEAK program, or Promoting Employment Across Kansas, and then the what's called HPIP, or High Performance Incentive Program for making capital investments. Those have employment requirements as parts of those, and now you can use work from home employees for those benefits, or to trigger those benefits. They still have to be Kansas residents. They have to be logged in on the Department of Labor reports, work a minimum, number of hours per week to be considered full time. So there are other requirements, and nuances to each of these states' programs that we do have to monitor. In fact, Kansas made so many changes last year that we actually have another article coming out just specifically addressing the changes in Kansas, because they've really taken a step forward. Now, Georgia, on the other hand, they sort of are reactionary. So they changed their job tax credit program to include telecommuting and remote employees, but really only for 2020 or 2021. So they're dipping a toe. They're not really 100% sure yet if they want to make this a permanent change, which is interesting, because, as we sit here today, this is really becoming more and more of a permanent change in states out there.
Yeah, I think those are really fascinating changes, and it will be interesting to see as this evolves if more states go that way. I do want to give you a little bit of a pop quiz, because you're so smart at incentives, and that is, if you think about some of the states that you see as really favorable for incentives and ones that you tend to focus on, what do you think some of the real hotbed states are that your group focuses on?
It used to be considered the Southeast. Everybody was looking at the Southeast as really being where you would get your most out of a tax credits and incentives deal. We're seeing now that trend changing. There are programs, across the country that are very, very effective and very valuable to employers. I would say now, the Midwest is easily holding up with the Southeast. There are certain states on each coast that are hard to work with, so there's a lot of compliance requirements with the incentives. The old saying that no money is free money. So you've got to do some work on that end, but some states are a little easier than others to work with. So I would say the Midwest and Southeast are still very good states for credits and incentives.
Yeah, I think that's a really good synopsis. And I think as you talk about this and you gave that synopsis, you did say that no money is free money. I think there's probably some other just good parting thoughts you might have as people are thinking about an overall strategy related to credits and incentives. So maybe you can just sum that up for us.
Well, yeah, I think one is that overall people were looking at telecommuting as a small part of their workforce, or remote workforce as a small sliver of their overall employment. I think with the pandemic, we're now seeing that that's going to be not a temporary or a fix to the pandemic. I think there's now going to be a lot more people doing remote and telecommuting work. So that's an important consideration, and keeping an eye on which states are going to allow you to count those employees towards your tax credits and incentives are very important. A couple other things to note, when you're looking at just overall, when you're looking at your activities for the next few years, if you're planning on making capital investment, if you're planning on hiring employees or implementing some training programs, make sure you get out in advance of that. These credits are prospective, which means you really have to apply beforehand or negotiate beforehand. Even statutory credits, which are as of right, you still have to usually put an application in before you conduct the triggering activity or the eligible activity. Negotiated benefits, discretionary incentives, definitely you have to be out in advance of those by usually a couple of months in order to get the best package put together. And the final thought is, incentives are great. It's my full-time job. It doesn't put me to sleep at night, Leslie, so there's that. But they are upfront, they're short term. When you look at your overall investment and the project that you might be undertaking, it's important to take in those long-term activities. If your property tax abatement that you negotiated ends after year 10, well, you're still going to be paying property taxes at the full amount for years 20 to 30, or 10 through 30, however long you're going to be in that facility. So taking in those long-term account costs is very important. We, in fact, use something called CLA has a program called Intuition, and it's a customizable long-range financial planning tool. We use that quite a bit for our site selection projects and our credits and incentives projects because it allows us to take into account a number of different financial scenarios and determine which is the best outcome. So.
I think that's a really good point. So lots of different moving pieces, and I think we'll keep you around. I know there's some questions rolling in that we'll bring you back for. So thank you. And we are going to pivot now over to Tim to get some great insights on supply chain. So Tim, it is awesome to have you. I know we have seen just a ton of challenges, especially as of late with supply chain. It's been a weird year and a half. And overall, I think those challenges have been slowness in supply chain. So what do you think are some of the drivers and macro trends related to what we're seeing?
Yeah, thanks, Leslie. And it's quite a big topic, isn't it? When you just talk about supply chain and you think about everything that goes into it, and
Like
if you
the whole
back
world,
up,
right?
basically, right? And if you back up a little bit, as hard as it is to remember, but was a time pre-COVID, pre-pandemic. And if you remember back to then, there was already some supply chain challenges, right? There was tariffs being instituted all over the world, particularly as it related to China, and the challenges that brought to our clients and to their businesses and supply chain. And heading into 2020, there was a lot of economic uncertainty, right? There was, we had a decade plus of a strong economy that, a lot were predicting there was going to be some sort of a correction or a recession. There would be some sort of a slowdown, outside of, nobody obviously predicted a pandemic, but there was a lot of uncertainty and companies were already starting to react in terms of how they manage their supply chain. So you take those two factors and now you add in, a global pandemic, which obviously there was the initial shutdown from that where there was no travel going on at all and air freight and a lot of businesses just came to a halt. And then as you come out of that, not knowing, okay, how much is our business going to be impacted, then you get this period of, and we're still in, of this sustained strong demand. But around the world, there's a lot of different start and stop nature to different countries' recoveries. So the pace of that is different. And if there's one that's off in your supply chain, that's going to just cascade throughout, the entire supply chain. So, that's obviously a contributing factor. Labor shortages, whether it's in the production aspect of your supply chain, if it's a shortage of drivers, just in the transportation or logistic aspect of your supply chain. Congestion at ports have contributed to it. So there's so many different factors. And again, all of this is going on despite just these sustained levels of strong, consistent demand. And we've obviously all experienced it as consumers, right? If you're trying to buy a car lately, if you're buying a house, if you're trying to order furniture and you're told it'll be 3+ months before it gets delivered, right? We're all experiencing it to some level, and certainly our clients are as well.
Yeah, I mean, so you just threw out just so many trends. And I think some of that history was good to think about and understand, because I do think so many of us forget about life, 18 months ago, 2 years ago, and all of it has really led up to what we're dealing with now. And it is kind of all this big impact that's kind of crunching together. So what do you think, if you think about that history and that journey that you just took us on, are the biggest impacts? And then what do you think seems to be having the most effect if you were to put that all together?
Yeah, again, I mean, it's tough, right? It's there's so many different factors that go into it, but I think, some of the impacts that our clients are feeling is just dramatic increases in their lead times. I talked to one client the other day that, they're a distributor here in the US, and they purchase 90% of what they sell from their parent company in Japan. And their lead times have increased almost 2 months over just normal lead times, whether that's ocean freight, whether that's air freight, so all of that type of stuff just is being impacted, and it's tough, right? And so you're trying to counteract that by purchasing more. You might choose to do more air freight than ocean freight to try to speed up those times, even though it's 2 months on top of traditional air freight. That might get you in line with maybe what a normal time was for ocean freight. So clients are dealing with that. And then probably the other main thing is pricing, right? Whether it's pricing from a raw materials or a product component standpoint, whether it's steel mills have limited supply, and they're assigning allocation levels to their customers, and so if a larger buyer is going to get preference. So a lot of our clients that are in that middle to lower middle market space may not get that preference. If you're a $20 million machine shop, you're not going to be able to compete with the $1 billion plus in terms of getting kind of in line and getting that preference when you're purchasing some of these raw materials. And then outside of just the product or raw material pricing, it's the actual costs of shipping have just gone up tremendously. Almost triple, some clients have mentioned, and just what it's costing because of just this. There's such a shortage of drivers. There's congestion at ports, so on and so forth. And in fact, I had one client tell me that they had to pay a late fee to the U.S. Customs warehouse because their order did not get picked up on time, and so it about doubled what their import fee should have been. And the reason it didn't get picked up on time was because their trucking company that they used didn't have enough drivers to be able to get there on time. So, it's things like that that are really just coming in, and clients and companies are having to deal with and pivot to.
Yeah, I mean, that's so interesting. And we're hearing a lot of that too in the client base that I've been talking to as well. And so I do think you are seeing the shipping, especially when it's coming from abroad. But do you think it just relates to international shipments, or do you think there's also domestic delays as well?
There's definitely domestic delays as well. I think, international may be feeling it a little more, but I mean, those are just longer lead times and longer process to start with. But, even once it lands and actually and finally gets through customs here in the US, there's issues with, just logistically moving it around the country again, just because of, just this huge increase in the demand for it, and just not enough drivers. Rail cars are full, you name it. I mean, there's just congestion throughout the entire supply chain from up and down, whether it's internationally or domestically. And again, that's part of the problem for those that are sourcing internationally. It's taking long enough to get through US customs, and you think, okay, we're through. Now let's go, let's get it. And then you're getting containers stuck throughout the country.
Yeah, and I think, so clearly Product delays are a big issue, and certainly that can cause all kinds of ripple effects because then maybe you can't drive sales and that can have problems. But outside of the obvious timing delays, what other impacts are you seeing this have on clients?
Yeah, like you said, I mean, obviously the timing delays are huge, and it's just, that impact with customers and customer relationships. I mean, if there is a silver lining to it, everyone's experiencing it. So it's not like, you look like the company that maybe isn't, handling their supply chain effectively. So, but other than just the timing, clients' profitability is being impacted. They're paying these increased shipping costs. They're paying higher prices for raw materials. You name it. The workforce shortages are out there. That's part of it, right? And so it's tough to find experienced labor, and if you do, they're in a spot where they're demanding, what our clients consider to be market wages. And so you have to make these decisions of, we could really try to get these people on board, but now we're going to have this sort of mismatch of here's what we're paying our people, and to get more, we got to pay them something else. And you kind of reset, the whole comp scenario for your company. And outside of that, it's just working capital requirements, right? How are you funding all of this, right? It's such long lead times in your cash cycles. So you've got, inventory sitting on the water, sitting on a plane, stuck in customs. You're purchasing more to try to counteract it. It's getting to your customers later. They're experiencing the same problem. So they're probably taking longer to pay you. Maybe they paid you in 45 to 60 days before, and maybe they're pushing you up to 90. So it's just, how are you getting through that? And just the cash constraints, working capital constraints can be a lot. And then just the risk it creates, right? Just the risk and uncertainty. I talked to an inventory manager of a client where their lead times, they're a distributor here in the US. They source most of their product from Taiwan. And he said, our lead time's gone from about 16 days to over 40. And so they're purchasing more, they're trying to purchase ahead. And he's like, Tim, I stay awake at night some nights because he's so afraid that the demand's going to come down, and they're having the best year they've ever had from a revenue perspective. But he's just so afraid that the demand's going to decrease before the supply chain gets figured out. And now you're stuck with this increased levels of inventory that potentially you can't sell. Right. So just the risk that creates for your business moving forward. And then, what's the impacts on that on valuation, right? If you were looking to have an exit or some sort of a transaction in the next year to 2 years while we're dealing with this, what's a buyer going to look at your company and say, hey, maybe some companies have reacted better than others in terms of supply chain, or your earnings are down. Maybe they're not going to pay you for that if they think this is going to be sustained. And so, it's just across the board, it can just really impact the entire organization.
Yeah, I mean, I think that's a really good view of the landscape. And certainly you've highlighted the landscape and then you've highlighted some of the risks and the downsides. I think it's always important to then say, okay, these are some of the risks and the downsides. We've got to also bring it back to what are some of the steps and the decisive actions that clients might be able to take to react to these changes and these challenges.
Yeah, absolutely. Right. You can't just play the victim card and not try to, counteract it and do what you can. And some things we've been advising clients, I mean, call us, we want to help, because we have the benefit of seeing this, happen, unfortunately, to thousands of our manufacturing clients. And so, we can help and kind of point you, hey, here's what one's doing that's maybe worked, or things like that. But, some things we're seeing is, ask for deposits from your customers, particularly if there's custom inventory that you're purchasing or producing for them. Maybe you didn't need to do that in the past, but ask for some deposits to help with that working capital needs. Look at your existing inventory. You might have some aged inventory out there that maybe you can recustomize, re-engineer, and maybe it's not, the ultimate end result for your customer, but maybe that helps get them through that longer lead time, and maybe it's a bit of a stopgap. And for you, has the benefit of maybe getting rid of some of that aged inventory that you've been keeping. So that's another opportunity. I think the obvious one is passing these cost increases to your customers, and really just being upfront with them, right? Like I said, I guess if there is a silver lining to it, everyone's experiencing it. So, the more you're upfront with your customers, they're going to get it, and you just be upfront to say, hey, here's the costs we're getting. we need to pass this through and pass it through from like a direct cost perspective. Say, hey, our steel prices are going up by X, and so we got to just go up by that same amount, right? We'll see some clients that try to say, hey, we're just going to try to increase our margin by 5% and cover this or things like that. And it's, you tend to lose visibility to, are you really capturing your cost increases or not? And so it's really just, just talk to them and pass through those direct cost increases that you're experiencing, or at least split it with them, right? And try to get through it together, because they want you to stay in business. They want you to be a healthy company. And so they're going to want to work with you on that. One potential, maybe longer view thing, Leslie, that you could potentially speak to is, if you think this is going to be sustained, if we think steel prices are going to keep climbing and climbing and climbing, then, you can maybe consider a LIFO adoption and from an inventory method, and maybe generate some initial tax savings to help with that cash flow or working capital constraints. And I think really it's just kind of looking internally and working with your banking partners to say, hey, we really need to get through this rough patch from working capital perspective. And maybe that's a temporary increase on a line of credit. Really understanding what's driving your inventory levels, right? It's easy to think, well, we're buying more, so that's why inventory's up. But don't lose visibility to that slow moving or aged inventory that could be still sitting out there. And I guess the last thing I would say, again, it's probably more long-term thinking, is just, do a risk management assessment of your supply chain, right? We talked about some of the supply chain challenges coming into 2020 prior to the pandemic. So there were already challenges. The pandemic just exacerbated it. But the one thing we do know for sure, there's gonna be supply chain challenges again in the future. So, learn from this, take that time, review your supply chain, look to reduce geographic concentrations if you can, diversify that. There's thoughts about, lean manufacturing and kind of moving to that just-in-time environment, but maybe there's that just-in-case component too, and maybe you take on a little more safety stock than you typically would in the past. So I think things like that to kind of look internally to say, hey, if this happens again, can we be better prepared for it on the front end?
Well, and I think the reality is that something will happen again, and the world's always going to keep changing. So I think these are just good strategies to keep de-risking your business and improving
Exactly.
the strength of your supply chain. So those are awesome strategies, and we appreciate your insights. Let's take a few questions from our viewers, if you wouldn't mind. I want to bring Patrick back as well, because we've got some incentives questions also. And I want to start with one related to incentives. And that is, if we are looking at incentives, how many employees do states require you to add in order for incentives to be valuable? And do you have to do that all in 1 year? And that may be a difficult question to answer, because maybe that varies by state, but maybe you can just give us some general thoughts that you have on that topic, Patrick.
Yeah, no, you're right. It does vary quite a bit. What we kind of use as a rule of thumb is 10 employees. Creating 10 net new jobs is enough to trigger a worthwhile, tax credit and incentives pursuit. It doesn't have to be in the first year. It can be typically over around 3 to 5 years, depending on the state or jurisdiction you're in. But as little as 2 jobs can be enough to trigger an incentive. Now, it might not be enough really to involve CLA in the pursuit, but it is enough for a smaller client to go ahead and do the paperwork themselves and receive some benefit. In Missouri, you can create 2 jobs in an enterprise zone that pay 80% of the average county wage, and you can retain those withholdings for up to 5 or 6 years. And that's a nice benefit for a small employer.
All right, guys, we are going to do something really crazy. Are you ready for this? We're going to tie in the ERC to both of these topics. So this is going to get wild here. All right, I'm going to start with Tim. And Tim, this one relates to the supply chain and the retention credit. And that is, with some of these disruptions in the supply chain, have you seen people take the ERC? And maybe that's because they've had some compression in their sales and it's caused their gross receipts to slide. What are you seeing out there?
Yeah, it's a great question. I'd say it's a little bit of a mixed bag, right? Like I said, I mean, we're in this period of really strong demand. And so a lot of our clients are having record years from a revenue perspective. And I hear clients say all the time, hey, we had our first, X $1 million month and things like that. And so, they may not qualify for the ERC because of that, because they're not experiencing those revenue declines relative to 2019. But yeah, I mean, those that are, and there are some, and maybe because it's timing or there's certain factors. So that's where it's really, really be in tune with your quarterly financials and your quarterly revenue totals, and be looking at that, and working, with your advisors to capture that, because the ERC can be, we talked about those working capital constraints, and so there's, nothing more that could help that than getting a cash inflow from the ERC credit for sure.
Yeah, absolutely. So another question that I want to tie to the ERC is that we've got people asking, let's say that they've had this downturn and so they get some of these ERC credits and now they're looking to expand their business. And so Patrick, this is where you come in. Are they able to use those ERC dollars that they get to do expansion projects that then possibly qualify for incentives? What are your thoughts?
Yeah, absolutely. That's a great idea. And in fact, that's something we should definitely be talking to all of our clients about. As they get that influx of cash, or credit back from the IRS, that's their money. So after that, it's unencumbered. They can use that to make an investment in their facility, and then that investment can then trigger potential state and local incentives as well. So that would be the best way to really get the best bang for your buck, so to speak.
Awesome. We have one more incentive question for you, Patrick, and that is, in terms of California, are you aware of any remote incentives there?
I do know California allows for remote employees to count towards the Cal Competes and certain other programs that they have. They do have some nuances if you're located in certain areas of California where, say it's a disadvantaged area, so a special category. Then there's some nuances to the program there, because they may have to not only live, but also they may have to not only have their place of employment located there, but they might have to live there in order to work there and generate the credit for the employer. So there's some nuances, but yeah, remote employees do qualify for Cal Competes and some of the other programs there.
That is awesome. Well, it is hard to believe that we are out of time. This has just flown by today. Thank you so much to both of you. I also want to thank our moderators that have been live with us, and all of you for your engagement and your questions. We encourage you to register and to continue to engage with us. We absolutely love having you be part of the conversation. We will see you next week, where we are going to continue to keep pace with policy changes. So until then, stay safe and healthy and have a wonderful weekend. Thank you so much.
Thank you.
Bye, everybody.